Silver has revealed its most consequential signals not during calm advances, but when stress ripples through the broader financial system. Today, as volatility tightens across currencies, rates, and equities, silver pressing into the $117 area isn't just a price event, it's a behavioral one, and the way markets respond here hints at pressures that haven't fully surfaced yet. At the surface, price action looks orderly, almost restrained, but beneath it, the structure is changing. Short-term liquidity thins as volatility spikes elsewhere, and silver begins to trade less like an industrial input and more like a balance sheet asset. That transition tends to happen quietly, before narratives adjust, and the timing of this test raises questions about what larger players may already be positioning for. Historically, when silver approaches psychologically loaded levels during periods of cross-market instability, the metal stops responding to traditional signals. Correlations loosen. Technical levels matter less than flows, and flows start to reflect risk management rather than speculation. What's notable this time is not the speed of the move, but the absence of visible selling pressure where it might normally appear. Behind the scenes, options markets and short-dated hedging activity suggest a defensive posture spreading well beyond metals. Silver's proximity to $117 coincides with rising uncertainty in assets that usually absorb stress first, implying that some participants are looking further down the chain. When that happens, silver often becomes a proxy for questions markets don't yet want to ask directly. At the institutional level, volatility isn't treated as noise. It's treated as information. As realized volatility expands across financial markets, internal models tend to reprice tail risk, and silver sits in an unusual position within that process. It's liquid enough to move quickly, yet constrained enough to expose imbalances when demand shifts, which makes this test more revealing than the price alone suggests. What's drawing attention now is how little effort it takes to keep silver near this zone. Order books appear thin, reactions muted, as if participants are waiting for confirmation from elsewhere. That kind of hesitation often precedes sharper adjustments, especially when external markets are already under strain. And as silver hovers near $117 while volatility continues to build across the system, the question isn't whether this level holds today, but what breaks first if it doesn't, because the answer may not be found in the metals market at all. Historically, when volatility expands unevenly across asset classes, stress doesn't travel in straight lines. It leaks. Silver's current behavior suggests it's absorbing pressure that hasn't fully expressed itself elsewhere. Equity indices may still appear functional and credit spreads contained, but silver tends to respond earlier to shifts in collateral confidence, not headline risk. What's different about this phase is the sequencing. Volatility in rates and currencies has intensified ahead of any visible deterioration in growth data, and silver is reacting to that mismatch. Market behavior implies concern over financing conditions rather than demand destruction, a distinction that often gets lost until it's too late. In prior cycles, silver testing elevated levels during volatility spikes coincided with tightening in off-exchange liquidity. Dealers reduce exposure, bid-ask spreads widen subtly, and price moves begin to reflect scarcity rather than enthusiasm. Available data suggests that pattern is forming again, though not yet in a way that draws public attention. At the same time, futures positioning shows less conviction than price alone would imply. This isn't a market crowded with directional bets. Instead, activity appears fragmented, risk managers adjusting exposure, hedgers extending duration, and speculative interest staying unusually restrained. That kind of composition tends to make price behavior deceptively calm right before it isn't. Silver at $179 sits at a point where traditional valuation frameworks offer little guidance. Industrial demand narratives fade, inflation hedging arguments feel incomplete, and what remains is balance sheet logic. When assets enter that territory, they often move in response to stress signals that aren't yet visible to most participants. What matters now is not the next dollar higher or lower, but whether volatility elsewhere continues to climb while silver refuses to give ground. If that divergence persists, it suggests silver is being treated as a placeholder for risk markets haven't fully repriced yet, and that has consequences far beyond metals. Because when an asset begins to reflect systemic uncertainty before the system acknowledges it, the next adjustment rarely arrives gently. For decades, the most telling silver moves have occurred when risk models stop agreeing with one another. That divergence is starting to show. Volatility assumptions embedded in equity derivatives, rate futures, and currency hedges are no longer aligned, and silver's behavior suggests it's being used as a quiet hedge against that inconsistency. In periods like this, silver's role shifts from expressing a view to absorbing uncertainty. Participants aren't buying because they expect a breakout. They're holding because selling feels premature. That subtle change in motivation alters how price reacts to pressure, and it's one reason sharp reversals often originate without warning. Reports indicate that intraday swings are being driven less by macro headlines and more by mechanical adjustments, margin recalculations, cross-asset rebalancing, and volatility targeting. Silver responds quickly to those forces because it sits at the intersection of multiple risk frameworks, and the 117 level amplifies that sensitivity. What's easy to miss is how little leverage appears to be driving this test. Unlike prior episodes, there's limited evidence of aggressive positioning chasing momentum. Instead, price advances look incremental, almost cautious, which tends to make the eventual release of pressure more asymmetric. At the same time, funding markets show early signs of strain that don't yet register as crisis. Small shifts in repo behavior, short-term borrowing costs, and collateral preferences rarely attract attention on their own. But silver has a history of reacting to those signals before they surface in broader risk assets. As volatility continues to ripple outward, silver's refusal to retreat from this zone becomes increasingly significant. It suggests that whatever is being hedged hasn't resolved, and markets may be underestimating how persistent that pressure could be. Because once hedging activity turns into outright repositioning, silver rarely stays quiet, and the transition can be abrupt. Behind closed doors, institutional risk discussions tend to focus less on direction and more on fragility. Silver near 117 is intersecting with that mindset. It's not being treated as a trade to monetize, but as an exposure to tolerate, which changes how sell-offs are handled when volatility accelerates. Available data suggests that drawdowns elsewhere are being met with rebalancing rather than liquidation. That distinction matters. When portfolios rebalance, assets with perceived optionality, like silver, often receive inflows by default, not conviction. This kind of demand is quiet, but it's also persistent, and it reshapes market depth in ways that only become obvious under stress. In previous environments, silver would typically face resistance at elevated levels as traders locked in gains. That behavior hasn't materialized in force. Instead, selling appears sporadic, quickly absorbed, and followed by long periods of inactivity. Such pauses usually indicate uncertainty about what comes next, not confidence that risk has passed. Meanwhile, volatility metrics across asset classes are sending mixed signals. Short-term measures spike, longer-dated expectations lag behind, and that gap leaves markets vulnerable to repricing if conditions fail to stabilize. Silver's steady posture amid that imbalance suggests it's being positioned for scenarios participants are reluctant to price directly. What's especially notable is how narratives lag the price. Public commentary still frames silver's move as an extension of familiar themes, while institutional behavior implies something more structural. That disconnect tends to resolve abruptly, either through a sharp move or a sudden shift in cross-market correlations. As long as volatility remains elevated and silver holds this ground, the pressure builds quietly. Markets can ignore inconsistencies for a time, but not indefinitely. And when they finally respond, the adjustment often reveals where stress has been hiding all along. Historically, when silver holds elevated levels during sustained volatility, attention eventually turns to what isn't trading. Capital stops rotating smoothly, correlations weaken, and certain markets grow unusually quiet. Those silences matter because they often signal hesitation among participants who normally provide stability. Silver near $117 appears to be reflecting that hesitation. Price action suggests that liquidity is present but selective, responding to necessity rather than opportunity. In this environment, even small imbalances can produce outsized moves, not because demand surges, but because willingness to supply recedes. Market behavior implies that some participants are prioritizing optionality over yield. That preference tends to surface when confidence in forecasting erodes. Silver fits that need well. It carries no credit risk, limited counterparty exposure, and remains mobile across jurisdictions, qualities that become more relevant as volatility broadens. What's unfolding also challenges conventional timing assumptions. Volatility spikes are often expected to resolve quickly, yet silver's persistence here suggests an underlying issue that isn't tied to a single event. When stress lacks a clear catalyst, markets struggle to price its duration, and assets like silver become placeholders for unresolved risk. At the same time, structural constraints quietly shape the response. Production, recycling, and inventory flows don't adjust on financial timelines. When financial demand shifts faster than physical supply, prices can remain elevated longer than models anticipate, especially when speculative participation is muted. As days pass without a decisive resolution, the significance of this level compounds. Silver isn't breaking higher, but it isn't backing away either, and that standoff keeps pressure distributed across the system. Because eventually something has to absorb the imbalance, and history suggests it won't be silver alone. At the institutional level, prolonged standoffs are rarely viewed as neutral. Silver's consolidation near 107 yuan, while volatility persists elsewhere, forces a reassessment of assumptions that normally go unchallenged. When assets refuse to revert as expected, risk frameworks begin to strain. What emerges in these phases is a subtle shift in behavior. Instead of chasing confirmation, participants start preparing for surprise. Hedging becomes layered, timelines extend, and sensitivity to secondary signals increases. Silver's stability in this zone suggests it's being used to bridge uncertainty between scenarios that can't yet be reconciled. Reports indicate that cross-asset hedges are being adjusted more frequently than directional positions. That implies concern over correlation risk rather than outright losses. Silver often benefits in that environment because it doesn't sit cleanly within any single asset class, making it useful when relationships break down. There's also a temporal element at work. Volatility today is reacting to short-term triggers, but silver appears to be pricing something slower moving. That mismatch creates tension. If near-term stress fades, silver's bid may look excessive. If it doesn't, other assets may need to catch up. What's important is how little new information is required to tip the balance. When markets are already sensitized, even modest developments can accelerate repricing. Silver's elevated footing suggests participants are aware of that asymmetry and are positioning accordingly. As long as this condition holds, the market remains vulnerable to nonlinear moves. Calm can persist, but it becomes increasingly fragile. Historically, late-stage volatility phases don't announce themselves with drama. They reveal themselves through endurance. Silver remaining anchored near 117s while other markets oscillate suggests endurance is being tested, not resolved. What's notable is how little enthusiasm accompanies this price level. There's no rush, no broad participation, and no clear narrative pulling new capital in. That absence points to positioning driven by caution rather than conviction, a dynamic that often precedes abrupt regime shifts. Market behavior implies that some institutions are treating silver as a contingency rather than a thesis. It's held not because it's expected to perform, but because it's expected to remain relevant under multiple outcomes. Assets held for that reason tend to be released only when clarity returns, not when volatility peaks. At the same time, stress indicators across financial markets continue to move out of sync. Some stabilize, others worsen, and that unevenness keeps uncertainty elevated. Silver's persistence reflects that fragmentation, mirroring a system that can't yet coordinate a single response. What's quietly increasing is sensitivity to time. The longer silver holds this zone without resolution, the more meaningful any eventual break becomes. Markets interpret duration as information, especially when it contradicts expectations of mean reversion. If clarity were imminent, silver would likely reflect that through retreat. Its refusal to do so suggests that participants aren't convinced the current volatility has fully played out. And when markets start to doubt their own timelines, adjustments tend to come suddenly, not gradually. At the institutional level, moments like this are often remembered less for what happened in silver and more for what followed elsewhere. Silver near $117, holding steady as volatility pulses through the system, represents a kind of unresolved signal, one that markets acknowledge quietly but don't yet act on decisively. What's increasingly clear is that this price behavior isn't isolated. It sits alongside subtle changes in risk tolerance, duration preference, and capital mobility. None of those shifts are dramatic on their own, but together they suggest a system adjusting internally while projecting surface stability. Silver's role in that adjustment is revealing. It isn't leading a narrative, and it isn't reacting to one either. It's simply there, absorbing uncertainty without offering resolution. Historically, that's the phase where markets underestimate the information being conveyed. As volatility continues to ebb and surge across financial markets, silver's test of this level becomes less about resistance or support, and more about patience. How long participants are willing to wait before repricing assumptions will matter more than the next data point or headline. If the broader system stabilizes, this episode will fade quietly. But if stress persists or deepens, silver's current posture may be remembered as an early indication that risk was being redistributed, not eliminated. Because when markets finally decide where that risk belongs, the move that follows rarely feels proportional to the calm that came before. For decades, markets have treated silver's most restrained moments as background noise, only to revisit them later as early warnings. This test, near $117, unfolding alongside uneven volatility across the financial system, fits that pattern uncomfortably well. What stands out in retrospect is rarely the price itself, but the context in which it held. Silver didn't surge on enthusiasm or retreat on relief. It remained present while other assets searched for direction, suggesting that uncertainty was being stored rather than resolved. As volatility cycles through different corners of the market, the significance of this episode depends on what follows. Stability would reframe this period as a temporary allocation shift. Continued stress would reveal it as a quiet redistribution of risk that went largely unnoticed at the time. Either way, silver's behavior here underscores a consistent truth about financial systems. The most important adjustments often begin before consensus recognizes the need for them. Signals appear not through drama, but through persistence. And when those signals are finally understood, they tend to explain moves that once seemed to come out of nowhere.